Welcome to the Deep Dive. Today, we are really digging into the Q3 2025 earnings call for Lemonade, ticker LMND.
Yeah.
And if you follow the insurtech space at all, this was, arguably the most anticipated report this year.
Absolutely. A lot riding on this one.
It felt like a really decisive quarter, signaled a pretty dramatic shift in where the company's heading, and investors reacted immediately. Very positive.
And that reaction, you have to remember, was kind of amplified by the whole situation going into the call.
High stakes, right?
Totally. The LMND story, it's always been this debate, is it pure growth or is there a real path to profit? And the short interest was sky high.
So any slip up would have been painful.
Instantly punished, yeah. But management, they didn't just meet expectations. They delivered something pretty rare. Accelerating growth and showing real, tangible proof that their AI model actually drives efficiency.
Okay, so our job here is to cut through the noise and pinpoint exactly where that proof lies in what they said.
Exactly. Let's distill it down.
All right, let's kick off with the headline numbers, the ones that really started that rally. There's a clean beat and looked like acceleration too.
Yeah, revenue hit $194.5 million, sailed past what analysts were expecting, shows that top-line momentum is still there, maybe even picking up.
Okay, and profitability.
Yes.
Because that's always been the big question mark.
Right. And that's where the operating leverage story starts to look, well, real. The GAAP EPS loss was $1.51. That's quite a bit better than the loss of $1.72 everyone was braced for.
That's a significant beat on the bottom line.
It is, but the real proof for me was the adjusted EBITDA loss. It narrowed dramatically, came in at negative $25.6 million.
Okay, and compare that for us.
Well, just a year ago, Q3 2024, it was negative $49 million. So you see that margin structure really starting to kind of snap into place.
And that improvement, it's happening while they're still growing fast.
Faster than expected, actually. The in-force premium, IFP, that hit $1.16 billion. That's 30% year-over-year growth.
30%, wow.
And here's the kicker for anyone tracking their path.
Yeah.
This is the 8th straight quarter where that IFP growth has accelerated. They hit a growth rate they previously said they wouldn't reach until sometime in 2026.
So they're literally ahead of schedule on their own projections.
They absolutely are. And the underlying metrics seem solid too. Customer count grew 24% up to 2.87 million.
Yeah.
Premium per customer was up a bit more modestly, 5%. But that's, likely tied to their broader strategy around profitability, which we should definitely get into.
Right.
But the mix shows they're adding new people and getting more value from existing ones.
Okay, but this kind of growth, it doesn't mean much if the underwriting is still bleeding cash.
Yeah.
Right. That was the old knock against them.
Exactly. So let's pivot right from the beat to the operations, because this is where the real story is, I think. Underwriting discipline.
What did the numbers show?
Company-wide gross loss ratio hit its best ever level, 62%. That's an 11-point improvement compared to last year.
11 points is a huge swing in insurance.
It's massive, especially with claims cost inflation hitting everyone else so hard. And if you smooth it out, the trailing 12-month gross loss ratio improved to 67%.
Any specific lines stand out? Car insurance is usually tough.
And they highlighted cars specifically. That loss ratio improved 16 points year over year, landed at 76%.
Just 15 points on car. Okay, that's
Just seeing a volatile line like that so quickly really shows that their data-driven, fast iteration model might actually be working.
Okay, underwriting is one part of efficiency. What about the cost of handling the claims themselves? The loss adjustment expense, LAE.
Right, the LAE ratio. This is where that AI focus really comes into play, and it's frankly pretty fascinating.
How so?
Their LAE ratio was 7%. Now, for context, think about the giants like State Farm or Geico. They have decades of scale, right?
Mm-hmm.
Their LAE ratios are usually around 9%. So Lemonade, being much smaller, is achieving better operational efficiency on claims handling.
How are they doing that?
They said they've cut the LAE ratio in half in just 3 years.
Wow.
And the engine behind that is their AI claim system. They call it Blender. Management actually said they've reduced the number of human claims adjusters.
Reduced headcount while growing.
Yeah, even while their claims volume shot up 2.5 times over a recent period, Blender lets each remaining adjuster handle 3 times the claims they could before.
Okay, so that's the operating leverage everyone talks about with AI.
That's exactly what it looks like in practice. Before, more policies meant hiring more adjusters. It was a variable cost that scaled up.
Right.
Now the AI platform just absorbs more volume. It turns that variable expense into more of a fixed cost structure. That's huge for long-term profitability.
Okay, Blender handles claims efficiency. What about the product side? They mentioned something called Loco.
Yeah, Loco. It's their LLM first, no-code product builder. Sounds like a tech tool, but it impacts the bottom line directly.
How does a no-code builder do that?
It basically speeds up their reaction time. It lets the product and actuarial teams, the non-coders, design and launch changes, rate adjustments, underwriting tweaks, things that used to take engineers weeks, in just hours.
So faster iteration.
Much faster. Think about Europe, where the rules are more flexible. Logo lets them adjust pricing almost instantly if a segment starts looking bad.
Ah, okay.
That agility is a big reason why their European loss ratio is already running something like 30 points better than the US was at the same stage.
That makes sense. And this agility, it feeds into their overall philosophy on profit, right? They said something kind of controversial on the call.
Yeah, they're pretty explicit. They are not optimizing for the loss ratio percentage itself.
So what's the target then, if not the best possible loss ratio?
The target is maximizing gross profit dollars in absolute terms.
Okay, explain that trade-off.
That figure hit $79.9 million this quarter, doubled year over year. They're saying they might accept a slightly higher loss ratio percentage in certain areas if a small price cut leads to a big jump in signups and people sticking around.
So if the total dollars of gross profit go up significantly, even if the percentage efficiency dips a bit, they'll do it.
They'll take that trade every single time. That's the goal.
Yeah.
Maximize the total pot of gross profit.
That's definitely a different way for insurance investors to think. You're asking them to look past the headline ratio sometimes.
It is. And they need proof it works. The proof they offered was gross profit is up 261% over 2 years.
261%.
While their core operating expenses, the non-growth stuff, only grew in the single digits over that same period. That's the leverage story right there.
Okay, that paints a clear picture. Managing for dollar volume, not just percentage purity.
Exactly. Vanity metrics versus actual profit generation.
All right, let's shift gears slightly. How are they applying this leverage? The car business seems to be a key growth area.
It's performing really well. Car IFP grew 40% year over year, and the economics look great.
Why?
Because over half, more than 50% of the new car policies came from people who already had Lemonade renters or homeowners insurance.
The cross-sell.
Exactly. They call it CAC-less acquisition. Basically, zero customer acquisition costs because they're just upselling their existing base.
And those customers are probably better risks.
Generally, yes. They tend to have better loss behavior. They stick around longer. It creates this positive feedback loop for gross profit.
Makes sense. Any expansion news there?
Yeah, they confirmed Pennsylvania is launching imminently. That puts their car product in 9 of the top 10 biggest U.S. cities. Big jump in the addressable market.
Okay, so U.S. car is scaling nicely. What about Europe? You mentioned it was growing fast.
Explosively.
Really?
170% growth rate this quarter.
Wow. Is that just finding the right market, or is it that regulatory flexibility again?
I think the regulatory environment is a huge advantage there. We talked about Loco and agility.
Right.
In Europe, they can use dynamic pricing, make changes much faster. Not like the US where you file state by state and wait months for approval.
So they can fine-tune the business almost in real time in Europe.
Pretty much. If something's not working, they can fix it immediately. That drives profitability much faster.
Got it. Looking further out, they also talked about autonomous driving, FSD. Seems early, but how are they positioning for that?
Well, their whole system is built for usage-based pricing and using real-time data. So fundamentally, they're kind of set up for it.
How so?
They can already tell the difference between miles driven by a human versus the car's system. And they highlighted their Tesla API integration.
What does that give them?
It lets them pull really granular data directly from the car, like, is the seatbelt fastened right now? Precise trip details. Much better than just using a phone app.
So better data for underwriting today and crucial for pricing risk accurately when FSD is common.
Exactly. Sharper underwriting now, ready for the future shift.
Okay, let's quickly cover governance and expenses. New board members, high-profile names.
Yeah, the VP of AI products for Meta and the CMO of PayPal Venmo.
What's the signal there?
It seems pretty clear. They feel the tech infrastructure is proven. Now they need people who know how to deploy AI at massive scale for consumers and how to build a mainstream brand.
So less about building the engine, more about driving adoption and monetization?
That's how it reads. Strategic expertise for the next growth phase. And on expenses generally, they did acknowledge a slight uptick in Q3.
Anything concerning?
They said it was planned investment, more spending on growth initiatives, hiring some tech talent. But critically, they reiterated the long-term trend. Overall, OpEx growth is still just single digits year over year. the leverage story holds.
Good context. Okay, let's bring it back to the investor view. Forward guidance.
They raised the full year 2025 revenue guidance, so confidence in the momentum continues.
And the big one, profitability target.
Still targeting positive quarterly adjusted EBITDA by Q4 2026. That target hasn't changed.
But now it feels more credible.
Much more. It's backed by the execution we just talked about. Plus, they delivered positive adjusted free cash flow for the second quarter in a row. $18 million this quarter.
Positive free cash flow is significant. Gives them breathing room.
Absolutely. Runway and flexibility.
They also talked about changing their reinsurance structure. That can be complicated.
Yeah, the quota share stuff. Basically, they're choosing to keep more of the risk and potential profit themselves.
Meaning?
The ceding rate, the chunk of premiums they hand off to reinsurers is going down. They estimated to be around 40% in Q4. Long term, they plan to keep about 80% of the business.
Why is that important?
It's a huge vote of confidence from management in their own underwriting. You only keep more risk if you're very sure the business you're keeping is high quality and profitable.
Got it. So, pulling it all together, this quarter wasn't just good numbers. It was like proof of concept delivered.
I think so. Accelerating growth plus proven operational discipline. The AI leverage isn't just theoretical anymore. And the market, especially with that high short interest, had to react.
The narrative shifted from maybe insurtech experiment toward profitable tech-enabled insurer.
That seems to be the read-through, yes.
Okay, that brings us perfectly to our favorite segment. This is not financial advice. Time to put on the hedge fund analyst hat.
All right, investment committee time. We're pitching an outrageous but plausible trade idea. Given the huge stock move, the volatility, but also that clear 2026 profit target, what's the play?
Okay, committee, listen up. We've got clear proof of leverage, a specific date for profitability Q4 26, and a stock that was heavily shorted, meaning lots of volatility.
So buying the stock directly might be a bumpy ride near term.
Exactly. Too much noise from squeezes or just general market jitters. We want exposure to that profitability switch, but we want to dampen the day-to-day swings.
Optionality then. Use options. Why not just buy calls expiring in late 2026?
Good question. We want more buffer. We want maximum time value working for us. So the pitch is a deep-in-the-money, long-dated call option strategy. Think January 2027 expiration.
January 27th, so well past the target date.
Right. Gives us over a year of cushion after the target Q4 2026 positive adjusted EBITDA quarter. We're playing for the potential multiple expansion.
Explain that.
Once Lemonade proves consistent profitability, the market won't value it just on revenue anymore. It'll shift to an EBITDA multiple, like other profitable tech companies. That re-rating could be explosive.
So the deep-in-the-money call captures more of that upside potential than an out-of-the-money one, and the long date reduces the time decay risk.
Precisely. And it protects us somewhat if, say, the PA launch causes some short-term hiccups or profitability gets pushed by a quarter or two.
You're acknowledging the execution risk, but betting the long-term trend is clear.
We are. The deep-in-the-money aspect makes it behave more like the stock, but with leverage and defined risk. The long date gives management time. Given the volatility, options seem smarter than straight equity here.
Okay, compelling pitch. High leverage, long duration, targeting a specific fundamental catalyst.
Thank you, committee.
All right, analyst hat off. Let's wrap this up. What's the single biggest takeaway listeners should have from this Lemonade deep dive?
It's that the Q3 25 call really showed their AI native model can deliver on both fronts simultaneously. They got accelerating growth, that 30% IFP, and serious operational efficiency. The record 62% loss ratio, the superior 7% LAE ratio.
Doing both at once was key.
It was the proof the market needed that the model is viable, that it works.
And the final provocative thought for our listeners to chew on.
Management flat out said they'll let the loss ratio percentage drift higher if it means maximizing absolute gross profit dollars. So the question for you, the experienced investor, is how do you adjust your thinking? How do you analyze a company using this dollar over percentage approach? Especially if, maybe next quarter, a traditional metric looks worse, but the actual underlying profit generation is stronger.
Yeah, that really forces a shift from focusing just on ratios to focusing on the volume of dollars coming in. A different way to measure success.
It absolutely is. Judging value by absolute profit, not just percentage efficiency.
That's a great point to end on. Thanks for joining us on the deep dive. Until next time, dig into those numbers yourself.